Hey everyone, and welcome back. Have you ever thought about the journey of the products you buy? A computer at Best Buy, for example, didn't just magically appear on the shelf. It started as a pile of microchips and components at a company like Intel. In accounting, every step of that journey has a cost, and today, we're going to follow the money. We'll explore how inventory costs flow through different types of companies and see how we calculate the single most important expense for a company that sells goods, the cost of goods sold. First, let's understand the players. We have manufacturing companies like Intel who make the products. They start with raw materials, use work in process inventory during assembly, and end with finished goods inventory ready to sell. Then we have merchandising companies like Best Buy who simply buy those finished goods and sell them to us. Their inventory journey is much simpler. But regardless of the company type, the fundamental math for tracking inventory cost is the same. We start with our beginning inventory, what we had on hand. We add the purchases we made during the year. Together, that gives us our total inventory available for sale. At the end of the year, this pool of costs gets split into two buckets. The inventory that was not sold, which is ending inventory and remains an asset on the balance sheet, and the inventory that was sold, which becomes the cost of goods sold, an expense on the income statement. Understanding this flow is the key to everything that follows. Alright, now that we know how we get that all-important cost of goods sold number, where does it go? It becomes the star player on a special report called the multiple-step income statement. Unlike a simple income statement, this format is designed to show multiple levels of profit, which gives investors a much clearer picture of a company's performance. Let's break it down, step by step. Step 1. Gross profit. We start at the top with revenues, or net sales, and subtract the cost of goods sold. The result is gross profit. This number is huge. It tells us how profitable the company is from just buying and selling its core product before considering any other business expenses. Step 2. Operating income. Next, we subtract all the other costs of running the main business called operating expenses. This includes things like advertising, salaries, rent, and depreciation. Gross profit minus operating expenses gives us operating income, sometimes called income from operations. This is arguably the most important metric for judging the performance of a company's primary business activities. Step 3. Income before income taxes. After that, we account for non-operating revenues and expenses, things that aren't part of the main business, like interest income or interest expense. This gives us income before income taxes. Step 4. Net income. Finally, we subtract the income tax expense, and that gives us the famous bottom line, net income. This is the final profit for the company after all revenues and expenses have been accounted for. So, let's recap. Today we follow the journey of inventory costs all the way from the factory floor to the bottom line of the income statement. We learned that the multiple-step income statement isn't just a list of numbers, it's a detailed story that shows exactly how a company generates its profit. If you can understand the difference between gross profit and operating income, you can analyze the health of a company's core business versus its other financial activities. That is a truly powerful skill for any investor or manager.